All right, we have a fine paisley tie today. Top of the morning. Today what I wanted to share with everybody is I don't always do stocks. I mostly do stocks on this portfolio set of blogs because stuff happens more often and they're more interesting. Mutual funds just typically buy and ignore for months and years at a time. But I did put together a good mutual fund portfolio I will share with you back from 2020, and I can show you what was expected and then what it actually did. This one pretty much performed on par. That's a good portfolio. But before I do that, let me give you a quick disclaimer. Reminder everybody, this is for entertainment and educational purposes only. And with that, let's get into it. Today is July 13th, top of the morning. I'm Captain Ron. Before I get into this good mutual fund portfolio from 20, I want to show you guys a pretty cool tool in the portfolio visualizer, the Monte Carlo Simulation. So this is the tool you want to use when you're trying to analyze a retirement portfolio. Assuming we have our retirement set up, what is the best portfolio to use for making periodic withdrawals? Either a fixed percentage, fixed number, or let's go into portfolio visualizer. And then the first one I'm going to look at is with these two. So just an S&P 500 mutual fund and a good bond mutual fund, both from Fidelity. Okay, so the Monte Carlo simulation. So first go into portfoliovisualizer.com and then analysis, tools, Monte Carlo simulation. Here's the Monte Carlo simulation, and we want tickers. And what's cool over here is we can do a withdrawal fixed amounts periodically, starting off with $1 million, good retirement account. And we're going to start by taking out $60,000 a year. And 30 years, let's see what happens. We've got a 50-50 portfolio. So this is 50%, so half the time it's going to be more than this, half the time it's going to be making less than this. So this is a portfolio that makes on average roughly 9% with a volatility of about 9%. The good conservative portfolio. We've got this perpetual withdrawal of $60,000 a year on $1 million portfolio. How long does it last? We've got the different curves, and if we do logarithmic, you can see it real easily. This bottom curve is going to be our 90 percentile curve. 90% of the time, it's going to do better than this. So this says that 10% of the time, this account is going to run out of money in 23 years. So 23 years, withdrawing at a fixed rate of $60,000 a year, you're going to run out of money. The other number we want to take a close look at is this perpetual withdrawal rate. It's 3.65%. If we had actually withdrawn at 3.65%, our portfolio would be okay. So this is a portfolio you can withdraw 3.65%. Let's go change this to be 80-20, so 80% stocks and only 20% bonds. So this will be a little more volatile, but ideally the ups will outweigh the downs, and we'll see what happens. So this portfolio, 80-20, withdrawing at $60,000 a year, we can see we have a much higher perpetual withdrawal rate. And if we look at the logarithmic scale, this actually makes it. So you've got a 90% chance that in 30 years, this portfolio will not run out of money withdrawing $60,000 a year. That is the beauty of this tool. So you can see, am I being too conservative and it's going to cost me in the future or not? Let's back this off to 60-40. We can see this portfolio is going to run out of money in 26 years. So the other what if we can play with this is we can see that our perpetual withdrawal rate is 4.3%. So if we go up here and we make our annual withdrawal, if we like this portfolio better, if we make this $43,000 a year, we will see that portfolio makes it just fine. The other piece of this is you don't have to withdraw a fixed amount. You can also change this to a fixed percentage. If I want to withdraw 6% a year, and this one does make it. The reason this one makes it, even though it did dip down here, is when it goes down, you're actually withdrawing less. So this is a safe 6%, but it's not 60,000. It's less than 60,000. This does go up, but it dips down to 56,000. Lots of other information. Just to wrap this up, you can take any portfolio, build it in here with the Monte Carlo simulation, run your withdrawal rates, and it will give you a feel for what the likelihood, the 90% likelihood or the 50% likelihood of the portfolio surviving. Let's go look at this portfolio I did 6 years ago. Real quick, I want to introduce another benchmark, a diversified benchmark, and this is a better benchmark to run up against a truly diversified portfolio. This is 58% Standard & Poor's 500, 10% the Russell, which gives you a good mix of big and small stocks, and then 17% bonds because there's 3% in cash in the other portfolios, and then 15% this Vanguard International stock ETF. So this gives you a good 80-20 portfolio that includes 15% international. That's what we'll run against our diversified portfolio. And here's how it does. This thing produces 11.4%. Standard deviation of 13, minus 2 sigma of minus 15. So it's a good, not completely aggressive portfolio, but yeah, it's a good portfolio. Our perpetual withdrawal rate is 5.2%, so higher than what we were looking at before. All right, so call the Wayback Machine. Back on February 21st, 2020, I came up with this portfolio, which is mostly mutual funds. It's got these mutual funds with AGG, which is a bond ETF, and a little bit of QQQ, which is the NASDAQ 100 ETF. Otherwise, it's a mix of stocks and bonds. And this one, back in 2020, has a perpetual withdrawal rate of 5.9%, so a little bit better than that benchmark. And this includes pulling 5% per year out. Withdrawing 5% was the way the portfolio was optimized. And if we look at how it's done, which is the top line over here, it has grown from 10,000 and went down a little bit with COVID, and then came back up to just about 18,000 today. So in 5 years, it's almost doubled. This is a good portfolio. We were expecting it to earn between 9 and 15% with an average of 12.4. Actual was 14.8. So we're running ahead of what was expected. The gain on the basis was 9.12%, not including the 5%. So very consistent with what was expected. This was rebalanced every 2 years, and the maximum drawdown was here, from here to here, which was almost 22% of the portfolio went down, and we were expecting a worst case of minus 45%. So we look at this portfolio, yeah, 21% bonds, so it's good. 2% foreign, so that's low. We can see sector allocation was very good, diversified across the sectors. This one had a preference toward large cap stocks. A slightly better portfolio might be large growth and small value, so in the two corners there. And then it had a good mix of stock style, actually a very good mix. And then if we look at the concentration, interestingly enough, back then, so now if you do another one, NVIDIA rises to the top, but this portfolio, based upon the data 5 years ago, looking back 10 years, it has Visa, Microsoft, MasterCard, IBM, and NextEra Energy are above NVIDIA in here. Visa, the top holding, interesting, very interesting, but less than 5%, so it did not break that 5% wall, so not too much stock concentration. And what I want to do next is, in another video, see if I can come up with something better. In conclusion, back in 2020, this was a good portfolio. It performed as predicted. It had a good mix of mutual funds and ETFs. There are no individual stocks in this portfolio. This is not perfect. Diversification could be improved with some international holdings. And again, that portfolio visualizer Monte Carlo tool is very good at understanding those withdrawal rates. So as you have a retirement portfolio and you withdraw at a periodic rate, fixed periodic on a budget, this will give you a good feel, statistically wise, that 90% statistics is what is good. Some advisors will use 85, some will use 95. I just got 90 in there. It's the default. But it'll give you a good feel for how well this portfolio should perform with a 90% confidence. All right, and with that, I will bid everybody adieu, top of the morning. And a reminder, that portfolio does matter. When you're making those periodic withdrawals, living on your savings, it most definitely matters. It's good to understand it.